Okay, let's do some Q&A from the last market outlook. Let's see what we have. CPI, April, 2.3. May, June, July. 2.8. Okay, I see what you're doing here. Broad expectations, inflation ending the year above 3%. 2% is the target. So this is misleading. What you have to do is you have to look at base effects. So if we take the CPI index, you start here, you end here, and then of course for the, this is 2024, and then you have 2025, you start here, and let's say we'll end here, and let's say that this is consistent with 2% inflation. So if you look at the index last year, it started the year like this, and then it went sideways for a while before it ended the year this way. So if you're looking at year over year, you'll notice that it would have decreased for a while. And even though the trajectory of this might be consistent with 2% inflation, look what's going to happen because of the base effects, right? Because the base effects, you're going to have what appears to be a rising inflation rate year over year because of that. So it is the month over month that you have to look at, and then the 3-month annualized. So if you took CPI month over month and annualized it, you would get something different other than this month over month because this base effect. Now, it would even be worse if last year you had something like this, if you had any deflation last year, because then it would really show, even if this was consistent with 2%, really show an increase year over year. So take the 3-month CPI and annualize that. You'll get a better read. That is much lower. Far more consistent with 2%. Holy geez, you wrote an essay here. I don't know if I'm going to read every word you wrote. Since May 2nd, the 2-year yield have come down 4% to 3.75. Real year yield now under 1%. Why you think cutting rates are a good idea here if inflation is not dealt with? Who says inflation is not dealt with? I would, before PPI today, I mean, we did see PPI. I would say that before PPI today, I would say that inflation was well dealt with. I'm going to have to do something here for a second to figure out where my, oh, there it is. Hang on. I got to get that little thing over here and drag it over here. I thought it was hidden somewhere else. If I don't have that, I cannot erase the screen because I need this lasso thing over here so that I can do this and hit delete. Isn't that clever? Technology, huh? I think inflation is dealt with. And what we saw in PPI today is the effect of tariffs, but tariffs only happen once. And that's it. So I don't know that we're going to continue to see it. And everyone's talking about, we expect. What about AI? What about technology? What about all of the deflationary effects that come with that? No one's talking, at least give it a head nod. If you're going to say, well, we expect this, in spite of what we expect, the deflationary effects of technology, we still expect, but they're only looking at one thing. They're looking on one side of the coin, not the other. I get labor data weakening, but I think Powell is too early if he's cutting rates and rising inflation. Again, what rising inflation? What you've shown me above was a series year over year without accounting for the base effects. Take the base effects out, you don't have rising inflation. Late last year, Fed cut 100 basis points. It reignited animal spirits in the market that celebrated rate cuts. I don't know that the market celebrated rate cuts. The market celebrated a Trump victory. The market really didn't celebrate rate cuts. You didn't have a market that was strongly upward trending until November 6th, and then it ran until the end of the year. So yes, you did have a strong market into the end of the year, but that was more the Trump effect and the expectation that, lower taxes, lower regulation. He learned a lot from his first term. He's not going to be that unhinged. He's going to be a different guy. He's going to be a more mature guy. No. No. After a Q3 correction, bond market slide said no. 10-year went up 100 basis points. The 10-year went up on the polling data. Remember when Biden was replaced with Harris, the gap between Trump and Biden narrowed to an even game. It was Trump's victory for sure if Biden stayed in. It narrowed. And then in late September, when it became very clear that Trump was going to win this one, the market then said, well, there goes the deficit. The deficit will get wider under the Republicans and under the Democrats. And that's what the long end of the curve responded to. It did not say, oh my God, you're cutting rates 100 basis points. We disagree. Inflation. We're going to push the long end up. It was all politically driven. The long end of the curve went up when it became clear that Trump was going to be the victor, and everyone sort of got on the same page that he'll only make the deficit worse than what it is. And then the market rally at the end of the year wasn't because of the rate cuts. It was because Trump won, and he was going to be absolutely pro-growth and a much more mature president. The belief at the time was. So you got to tear that apart. I think cutting now we get the same outcome. Bond market says no, we can't have those low yields that Fed wants to fight inflation. I think you have no choice but to go to the zero line. If you want there to be an America, I think you have to go to the zero line simply because of all the bad decisions about issuing debt that have been made and about the size of the debt to GDP. And now the I would say, anti-growth policies that Trump is following with these tariffs. No one's onshoring production that wasn't already going to onshore production. Companies that are saying they're onshoring production are doing it to get a break from the tariffs, for now. I'm not going to spend billions and billions of dollars on building something that takes 3.5 years only to find out a new administration comes out and says, no, don't worry about it. I don't think so. What I see is a common September-October correction, 5 to 10% on SPX. On that, I would say, with what catalyst? You see it, but with what catalyst? What's going to cause a 5 or 10% correction? And celebrate rate cuts and V-shape higher into... Okay, that's a very specific forecast. I would say, is this sort of your best guess? Or what do you have that would back up that catalyst and these events happening in that order? I don't know that I would take that. Rally will be the big blow off. Oh, we're going to keep going with the precise forecast. Okay, so this is what you think. So we'll let other people read it if they want. But why do you always see the NASDAQ winning in every economic condition? I wouldn't say every economic condition the NASDAQ wins. The NASDAQ outperforms in bull markets. The NASDAQ outperforms in the late early recovery to mid recovery to late recovery. It tends to outperform, but I wouldn't say it's winning in every economic condition. You don't follow closely in the videos. Tech is such an interesting and important section of the market. But it's heavily skewed towards one or two sectors of the market, heavily skewed towards information technology and communications. Whereas the economy, if you want a barometer of the economy, the S&P is a better barometer of the economy because you have materials exposure, you have utilities, you have financials. The NASDAQ is heavily skewed towards and really overweight a few of the sectors. It's not a broad index of economic health. The S&P is a better sort of measure from investors about the broad economic health of the economy. Question on your Google thesis: how does your valuation account for the binary risk of the impending remedy ruling in the DOJ's ad tech antitrust case? Whatever the outcome will be appealed. It'll just be kicked down the road. Whatever outcome happens will be appealed. How do you weigh a forced divestiture versus a simple fine, and what impact do you see for either outcome? Well, this is why Google is trading as low as it is. I seem to think that it can trade up into that event. I'm not sure that that's the end of it. So I don't know that I'd be too concerned. Or at least I'm not too concerned. I'd get rid of that. You'd be at 25 to 30 times forward earnings, not 19 or 20. We're sitting at what, 20, low 20s, 20 and a half times forward earnings. The S&P as a blended portfolio of all the sectors, trades for a higher multiple than Google does, because that is priced in. At 23, I would say it's priced in. You get a positive result for Google, you could trade to 25, 26, 28, 30 times forward earnings. How long have you been actively managing your portfolio? 27 years? But as a professor yourself, can you guide how to get the maximum value of Notebook LM? Well, you're asking me to hold a 2-hour class on Notebook LM. Not really. Just start using it. It's like anything. Just start using it. You'll figure it out. It's the best way to do it, is just to jump right in. For CFA reading, should I just feed it the whole? Try it out. Do you agree with the statement, you said facts don't have a bias one way or another, but people will not check the sources that LLMs are referring to and fact check them as they are lazy? This will lead to more stupid or No, I see what you're saying there, that if they rely on the output, it'll lead to more stupid people. No, it wouldn't. Because as wrong as the LLMs are sometimes, they are more correct than most people. If you listen to Fox News, you will be misinformed and heavily biased. If you listen to MSNBC and CNN, you will be misinformed and heavily biased. If anything, if you get rid of that and you simply just rely on the output from the LLM, you will be 80% informed, 20% misinformed, as opposed to 50% misinformed. If anything, it will raise the intelligence level, right? Because you'll only be wrong 20% of the time, or 10% of the time. So I don't think that it's going to create a world of stupid people unless all the output from the LLMs was just nonsense. That's simply not true. So if let's take the CFA program, for example. Excuse me. I've hired people in the past to produce content for me. A lot of them were worse than the LLMs that are around today. And these are charter holders, where some of them had no fundamental understanding of what they were talking about. One was a university professor. Another one was a university lecturer from down south. I won't name who it is, but just the amount this person didn't understand was shocking. Now that was bad output. So the LLM today is far better than these people were. So I do see it as improving things, not taking away. Do you think we are just the derivatives of what media we read, see, the people we hear and talk to in our own life experience? We're derivatives of? I think some people are all too eager to absorb and believe what they hear. If they hear it on TV, it must be true. How can they lie? There are some people who will believe what they hear, sure. But I mean, are we not all informed by the stuff we read, even if we know and understand what we're doing? Are we not all a product of the smart and stupid decisions we've made and the sum of all the knowledge we have? So you could say that we are derivative that way ourselves, that everyone is. What do we have next, guys? I found a gem. Oh, okay, skip that. Oh, I did answer this one. In your recent videos, you've noted how AI has increased your productivity and how the proliferation of AI will lead to improving productivity and deflationary trends. However, I think people generally overlooking the negative aspect of AI on productivity. Recently on Lot's podcast, they had a lawyer on and they talked about how AI could result in more lawsuits. Shocking. They had a lawyer who saw more lawsuits coming. You could probably have a dentist on there saying, oh, there'll just be more dental work. People will be so using AI so much they'll fail to brush their teeth and follow proper oral hygiene. There'll be more dental work. I mean, a lawyer saying that there'll be more lawyer stuff. Okay. More lawsuits as the LLMs will need more people to file lawsuits. How's that? What does that have to do with productivity? As a potential negative for productivity. Why is that a potential negative for productivity? You're going to have to explain that one to me. How does me filing a lawsuit mean that I'm going to produce less at work all of a sudden? I don't understand how you get to, oh, I'm filing a lawsuit so I can't really output as much as I used to. My boss will understand. You're going to have to tell me how you get to that. A number of U.S. health insurers have noted that healthcare providers have been upcoding for more services using AI, and the insurers will need to develop. Okay, I know nothing about healthcare insurance, so I'll pass on that. All that is to say, aren't we generally underestimating the negative impacts of AI on productivity? You haven't made your case at all that there's negative productivity. You say there'll be more lawsuits, and then you run right to that's a potential negative for productivity. And then you end by asking me, well, what say you? I say you haven't made your case. I don't see how filing a lawsuit is negative for productivity. So on this one, I would say I don't see how it is negative for productivity. Okay, next is still commenting on above. Dying to get an MM cap. Any plan for some merchandising? Those who come down to Costa Rica, if you're down here, I have, I think 35 hats. I give you a hat if you're down here. Monday the 11th, ZQ September 25 was pricing in about 10 basis point cut. Well, so ZQ, here's month. Here is September 1st. Here is September 30th. And whatever ZQ price here is, it is the average of all of the rates, the effective federal funds rate for the month. So you have a meeting over here. So you'll have one rate over here, and if you get a cut, you'll have another rate over here, such that the average of all of these might be 10 basis points lower, which means it's pricing in a cut for the meeting date in September. So no, I don't think there's anything to trade there. There's a comment for ZQ futures pricing and CME probability differ. They don't differ. The CME pricing is drawn from ZQ futures. Do you think it's fair to consider CFA charter holders to be in the top 1 to 5% of the world population in terms of cognitive levels and abilities? No, just as I don't think that you can say that all university graduates are there. What you can say is that given the distribution in the population of 5%, if we had charter holders, I would say the distribution, oops, not so much there, I'd say the mean of the distribution would probably be shifted a little bit more, such that the mean of the distribution might be over here, so that there's a higher, in the distribution, you'd probably have a higher representation of people in the top 5% in terms of cognitive skill, but that does not mean they are all in that distribution, just that the type of people that make it to that level probably were the median of that, or the middle of that distribution was probably higher, so that there's a difference of means between the two. So no, I wouldn't say that they are there. I would say that I'd say the probability is such that there'd be an overrepresentation in that sample of this group of people from the population. Which markets you anticipate getting impacted when you expect reserves to draw down? None. No, I don't think any market gets impacted. Do you see then only Fed changing assets from MBS to Treasuries? Don't see how that has anything to do with the overnight. No, I don't see how doing that would do anything. Providing some relief to long-term yields. So the overnight rate is at the federal funds rate, not at the long end of the curve. It wouldn't matter. Curious to understand why Fed wants to keep MBS on its books when it's a non-performing asset. Who says it's non-performing? It's performing. I don't know that we can say that they're non-performing assets. They collect every month. They collect their MBS. They collect their principal and interest and any prepayments every month. It's just, they're allowing so much to run off every month. Being that rates are so high, prepayments are low, they're not hitting their ceiling on that. But, it is a performing asset. So given current mortgage rates in Canada of 3.9, 4.2, would you still lean towards variable mortgage? I don't know about Canada. The US, yeah, but I don't know about Canada. Wouldn't lower energy costs such as 0.0003 kilowatt hours per LLM query? Are you sure it's there? Now, is that the language model or the reasoning model? Well, I'm sure the reasoning model is more intensive. And I know that I've given the reasoning model some tasks where it works for 7-8 minutes before it comes back. That cannot possibly cost that amount. And that's just let's just go with that amount. That's just a variable cost of the electricity to run the instruction set. You have the cost of the hardware. Well, that hardware doesn't last forever, so that hardware has to be depreciated over time. You have the rent for the facility that it happens to be in, and that rent probably has an escalator clause with it as well. You have to air condition that unit as well, and that's going to increase at whatever rate of inflation there is. You're going to need staff in that location as well, and that staff wants a raise over time. It is not just, you're just looking at one thing. How much does it cost, variable cost in electricity to execute one instruction without telling me what kind of instruction it is? I mean, I know that I've requested from the LLM to write me 30-page reports on things just to see what I would get, to see if there's any interesting starting points from that. And it's 7-8 minutes. You can't tell me it costs that little to run that. And this is just to run an instruction set. You had to train the model beforehand on a bunch of NVIDIA GPUs. And you had to train it. Usually it's 25, 30 days to train a model of that size. So you have the model cost. So yeah, you can't just say, well, here is the cost per set. What do you mean no one's making any money? You got all of this stuff. And this depreciation over here is 3 years, maybe 4 years. Right? So no. You got layers upon layers of costs to get this done. Not only that, the bandwidth that you need coming into these places, right? The bandwidth that you need, and then the redundant bandwidth that you need, the utility for the power you have coming into this place, and then the redundant power that you have coming into this place. You got to layer on way more costs than that. Way more costs than that. About the prices likely going up for Gen AI, I think there's good reason to believe that efficiency increases may lower the cost. Sure, efficiency increases will lower the cost in time. It will lower the cost. But you still have all of these costs that have to be recovered. And then just the sheer cost of the infrastructure that you have to put in place. None of these companies are making money right now. AI providers using more efficient design hardware and smarter software. The industry is still quite early on the optimization curve. I think at some point it's going to make money. There's going to be a significant fallout. Not everybody's going to be able to make money. Costs will be driven down, but only to a certain point. These things will still generate heat. You're not going to get cheaper rent. You're not going to get cheaper AC. You're not going to get cheaper staff. You may get cheaper hardware over time, but it's still going to be depreciated. So your electricity costs may go down over time in your model training, but you're still talking about billions in CapEx, and then your maintenance CapEx, because your model's now better than my model. I have no choice but to spend even more money. No. Even with the incremental savings per instruction set, perhaps it's still going to be an incredibly high price. Even if you get it down, even all in, let's say you get it down to 50 cents for a 5-minute session. If you're running for 5 minutes, asking it this and like giving it a really tough task for 5 minutes, and you're at 50 cents on something like that, you're running $3 an hour. And let's say you're using it 8 hours a day. You're $24 a day. and you're using it all month long, every single day, and let's say that's for 30 days, that's $720 a month of cost. Now you got to put a margin on. You want to have 45-point margins. You got to be selling this for about $1,200 a month for somebody who's going to use it at that level, even if you can get it down. That's all in. 50 cents for every 10 minutes for the allocation of staff, the allocation of air conditioning, the allocation of rent, the allocation of the hardware, the depreciation on the hardware, the allocation of the electricity to execute the instruction set, the allocation of the cost you had in developing the model to begin with before it's deployed. Let's say you get it down to 50 cents and you have people using it 8 hours a day. $1,200 to price that. How few queries can you do for $26.99? 52. That means on average 2 a day. Or you're using it for on average 10 minutes a day, and then you're using up the $26. But this $26.99 all you can eat buffet, those days are limited. Those days are going to end. Also, not to be surprised if we saw more paid local computing using GPUs and NPUs on the user system, leveraging. I can see downloading a lot of the work to your computer. I think the easiest thing to download to your Windows is the tokenization of your prompt. Tokenize the prompt on the computer. I'm not really sure what's involved in getting that done, but I think you can tokenize it on your own system and then enter the just the final token, as opposed to sending the query and then having the system tokenize it. Altman mentioned OAI is losing millions because users are saying please and thank you. Yeah, those are tokens in. You have to create a token and then you have to find it in probability space, because the computer doesn't know, the model doesn't know, oh, that's a please and thank you, we can ignore that. It must first determine every single time whether it can ignore that. Yeah, that's why these things are not intelligent, and they do not learn. They execute code. The output may appear intelligent, that you read it and you go, well, this is some really good output. I would say let's stop calling it intelligent output and let's call it elegant output. That this output is elegant. That the algorithm is elegant. The transformer algorithm is elegant, and it can produce elegant output. And the models are elegant, but I would not say they are intelligent at all. Not even close. They have no, what we would refer to as intelligence. They have no intelligence. They have no mind. They have nothing there. It's just code. It's just code. That's all it is. A few $100s per user, to say nothing of a few grand per user, would likely considerably shrink the user pool. Yes, it would. Which means I would look for much smaller numbers of foundational models, because you can't have this many. There aren't enough people to go around to support 15 foundational models. It's going to shake out to a couple of models. My guess is there'll be one or two that are closed and one that is open. The market will split itself that way. There'll be a bunch of small little ones that really aren't doing very much that will disappear over time. It'll come down to an oligopoly, and it will be scaled down models, so that the newest model, let's say OpenAI has ChatGPT 5, that you'll continue to use 4.5 for the $25.99 a month, and it'll be scaled down such that you have so many, like once you hit so many tokens, that's it for the month. It'll be something, or there'll be some advertising. It'll figure out how to get somebody else to pay. But if you want the newer models, then you upgrade. There might even be just, as an example, 3 different levels. $25 a month or $20 a month, you get GPT-3 or the 3 series. If you're paying $49.99 a month, you'll get the 4 series, and if you're paying $99.99 a month, you get the 5 series. I could see something like that. But this $20 all you can eat stuff, that's going to go away. That's going to go away. Are you conducting a live Discord session every week or not? Not every week, no. I could not find out. Reminder. I have one, well, by the time you hear this, it'll already be done. It's 3:50 p.m. I got one in an hour. You and I are on the same page with Lulu, except with one exception. I'm a little hesitant to sell cover calls just yet. Want to see a rebound first. So what I do is, it's just a rule. If the target that I have is the underlying, if any asset is down 20%, I immediately move into risk management. Have I had situations where, I shouldn't have done that, it was too early? Yeah. Have I had situations where I say, thank God I did it? Yeah. That's the point. It's for the thank God I did it. But if it trips 20%, that's it. Risk management. Not risk elimination, risk management. Let's move into risk management right away. Right away. Without thinking. I'm not going to negotiate with myself on that. Oh, it'll come back. I want to see it do this first. Maybe it'll do this. Nope. I just go right into risk management, period. Learned this lesson. Microsoft during the downturn after the tariff announcement bought Microsoft around 372, sold calls at 395, got a sign. 3 months later, it's over 500. Well, you're never going to be 100% right on 100% of the positions you have. No one in the history of this game has a 100% record, not even Warren Buffett. All you can do is make decisions that are right for you in the moment of how you feel about it and how it makes you feel. What you don't want is a position that stresses you out, because it'll start affecting other decisions that you make, right? So you have a rule. At this level, I engage in risk management. If I was uncomfortable with a position doing something, I shouldn't have been in it. My cost base on Lulu's around 206. I want to see it climb back above 225 or maybe 250 before I start selling cover calls. Well, I would say everyone should do what is right for their level of risk tolerance. What I would do and what you would do are two different things. Maybe you are comfortable with that. I have 1,100 shares. So there's only a certain amount of comfort I'm going to put up with when every dollar down costs me $1,100. $10 down, there's 11 grand. Right? I have a different level of willingness to move in and make decisions when that's the case. You may be younger, you may have a higher level of risk tolerance, and that's fine. So I would say, if you want my thoughts are, if that is right for you, then that is what you should do. My mindset dramatically changed after I started listening to you. I hope for the better. Wish I'd found you 7 years ago. Well, okay, so that must be a good thing. What do you think about Perplexity's offer to buy Chrome? Oh, it was a moonshot offer. That was never going to happen. It wasn't like somebody at Google was going to say, sold, done. They can get a hell of a lot more for that. What is it, 3 billion users, 3 billion active monthly users or something like that? Is a ridiculous number. To get those eyeballs, to have those particular eyeballs, that's huge. I don't even know that Facebook has that kind of reach that Chrome has. It's a big thing to lose. It's a big thing to lose, and it'll be worth a hell of a lot more than $34.5 billion. It could be great marketing. Perplexity offering to buy Google. Holy Jesus, this young startup, they must have a set of balls on them. What great marketing, because now you're going to have Wall Street Journal write about it, Barron's write about it, you're going to have a CNBC talk about it, you're going to have Bloomberg talk about Perplexity. If you never heard of Perplexity before, you're going to Google, what a terrible thing to say, you're going to Google Perplexity. Somebody at Perplexity is just, grimacing at that. Don't Google Perplexity. Perplexity Google, right? So, and then you're going to find out what it is, you're going to try it out for a while, and you're going to say, hey, this is not bad. I bet you got them a bunch of eyeballs, right? They weren't going to take that offer. On the same page as you regarding AI, I've seen firsthand at a major Swedish company that there's immense pressure to cut down on costs by using AI. Some departments have even been given a yearly 10% cost-cutting target. Look, I've talked to other people as well, at least in the circle that I'm around, and in the neighborhood that I'm in, they're all professional people about AI. It is being used. It is being used. So, I don't know that on this technology that we're not going to really see the effects of it for another 2 years. I think we're already seeing the effects of it, and we haven't seen anything yet. Have you had a chance? Oh, hang on. I'm having difficulty understanding purchasing power parity. How would I find the PPP and apply it, for example, into Euro US? Well, purchasing power parity has some assumptions, and one of them is that you have no frictions across countries, so that if I can buy something in Europe and bring it to the US, get US dollars, convert those back to euros and end up with some profit, I have an arbitrage, what's called goods arbitrage situation. So I should do that as long as I can. That doesn't work when there's tariffs. That doesn't work when there's high transportation costs. That doesn't work when you have different types of taxes that get involved. So on a broad basis, you can say, what would the currencies be if none of those frictions were in place? That is purchasing power parity. And that you can make the assumptions that over time trade flows would lean towards where there would be some opportunity to trade that way. It tends to be a reversion level for currencies in the mid to long term. Tends to be. But purchasing power parity can change year over year. So being that it can change, you're aiming towards a moving target. And in the end, it is just a theory. That doesn't mean that currencies actually do that. It's just a theory. You ever had a chance to try fiscal AI? Nope. If US were to officially enter stagflation next 1 or 2 years, how would you trade it? The only way I see them entering stagflation is to have a Fed that just keeps rates low in the face of inflation, which would be a Trump-led and a Trump-dominated Fed. But I'm already of the mind that with Trump in place, the U.S. is slowly becoming uninvestable, even though the market keeps going up. I do think you're looking at a long-term decline on the dollar. I don't know that the Mad King is done doing what the Mad King wants to do. I still don't know whether you're going to have another presidential election or the Constitution will be set aside, martial law will be declared, and you will have a dictator. Jury's still out on that. So if you did go into a situation where you had a Trump administration-led Fed that bend to his will, and you had inflation with low growth, the U.S. would finally be uninvestable. So I probably wouldn't trade it at all. I'd trade away from it. Short the U.S. dollar under those situations. Keep saying market doesn't make sense, but many of the economists I follow are saying we are entering a new age. So many of the economists you follow are saying something you probably already believe, which is why those are the economists that you follow. Many economists say the opposite, right? So, when somebody says, all the people I listen to say this, yeah, because those are the people you listen to because they're saying stuff you want to hear. That doesn't mean that you've found this population saying, listen, everywhere I turn, people are saying this. It is what you're choosing to listen to, and you're listening to someone who says, hey, they're saying things that I believe in. Let me see what they have to say. It could be just that you're living in a self-reinforcing world. We are entering into a new age of both inflation and growth that will last at least 4 to 5 years. How do they know that? How do they know it's going to last 4 to 5 years? How does anybody know that? That's just somebody guessing. Inflation and growth is going to last 4 to 5 years. How do they know that? I don't know. That we will have some corrections here and there, but that the trend is up from For now, they seem to be correct. Well, everyone is correct in their own time. Everyone is correct in their own time. I can find you 10 economists for every 10 economists you have that say the opposite. The economy is a complex system. All of these forecasts are just nonsense. Really? It's going to do this, it's going to do that. Well, how do you know? You know, the future is not, it's not that the future is unknown to anyone. It's that the future is unknowable. There's nothing to know because it hasn't happened yet. There isn't some future that is already there that we simply don't know about. We just have to wait until we get to it. It doesn't exist. So how to say, 4 or 5 years we're going to go up with a correction here and there? How do you know? I don't know. I don't like those arguments. Well, this person is an economist, so they must know something. They say it's going up, so there you go. Defend yourself. It's like, well, that's not a catalyst. An economy saying we're going up is not a catalyst for why we should be going up or why growth would still continue. Give me some real variables in the economy, some catalysts that I could look at and say, okay, well, those are your variables, that's fine. But to say that my variables are the economists I listen to that say the things that I agree with are saying we're going up for 5 years, that's not a cause and effect relationship. That is a correlation. The economists are highly correlated with what you're predisposed to listen to. So, I don't think there's anything there. Appears to me that just by looking at the person's pedigree in terms of where he or she studied or worked before gets me 60-70% of an idea to understand if the person is indeed qualified or really good practitioner in his or her field. I think that pedigree tells you something about what the person was willing to do. You know, you don't just show up at Yale or Princeton, right? I mean, you had to put in a bunch of work and effort to get there. So that if you graduate from there, I can at least say something about the pride you take in yourself and you know, especially what it took for you to get there. That you have some gifts. Whether you use them wisely while you were in university is another story, but you had some gifts, sure. In the case of recent U.S. labor statistics, I know this guy's something else, eh? Along with understanding President Trump presidency practice, I have become pretty much sure this person is not likely the best hire you can have at this time. None of them are. None of them are. That's not the point. Trump cares little of merit. It's loyalty. Do you believe what I believe? Do you believe these numbers are rigged by this Democrat that was in charge, this Biden appointee? Do you believe it? Yes, sir, I believe it. Do you believe me? Yes, sir, I believe you. Are you on the same page as me? If I ask you to do this, will you do it? Yes, sir, yes, sir, yes, sir. Okay, good. You pass all the tests. You are loyal to me and you believe what I believe. Here's a job for you. That's all the hiring process is involved with this guy. Is just if you're going to say yes sir, no sir, 3 bags full sir, you'll get a job. Do you think it's true that where did you study or work before explains to what extent the trust people embedded? There are untrustful people in Harvard, in MIT, and in Tri-County Community College. There are untrustworthy people everywhere. I don't know that he went to a good school or she went to a good school, I trust her. Trust has 2 dimensions, right? There is the competence dimension and there is the benevolence dimension. So to say that you trust somebody, you have both competence and benevolence. Benevolence means this is a good person. Competence means they can do the job. So there are people I trust that have competence, but I wouldn't leave a dime on the table in their presence. And there are some people where I'll give them the PIN number to my bank account and the card, not a penny will be missing, but I'm not hiring them for anything, right? So trust is, to say that based on where a person worked and went to school, do you trust them? That's a tough one. I don't know that I would say straight up. What do you think of oil for the next 3, 6, 12 months? I don't think anything of it. I think we have plenty of it, and I think we're past peak demand. WTI crude 63, Brent at 66. Prices have been very low for a while now. Oil rigs starting to shut down. Starting to shut down a lot. Baker Hughes show 411 active rigs in USA. Let's be careful about the types of words that we use. They're starting to shut down a lot. Are you sure about that? That if I press you in a Socratic method about are they starting to shut down? Or, has the decline in the rig count been going on for some time? And it has been going on for some time. When you say a lot, what is a lot? With enhanced oil recovery, and especially with unconventional drilling, so you have a pad location, rather than having all these pad locations, right? What you can do now is you can have one location that can drill vertical or horizontal lines. From one location, you can drill in multiple directions now. So you may not need that many rigs to produce the same quantity of oil. So it's what you would look at is you'd look at the decline in the rig count while the production quantity was going up, telling you that each rig is becoming more productive. And then you have EOR, enhanced oil recovery, which forces CO2 down to increase the pressure to bring more oil up. There's a lot of interesting technologies that allow you to increase the life of a well by increasing the pressure in the well, and from one location to hit multiple reservoirs at the same time. I don't know that the rig count is important for E&P. So you have upstream, midstream, and downstream, right? If you're looking at rig count, you're probably saying, okay, well, it's important for upstream, but technological improvement has shown that over time you have a rig count that's dropping, but oil production that's increasing. Where the rig count really comes in is the OIH, the oil servicers. Every rig in operation needs servicing, maintenance, a maintenance contract, maintenance capex spend on every single rig. So where the rig count matters more is for the oil services companies and not so much for the E&P companies anymore. So I don't know that I think you're looking at an indicator for the wrong thing. So we haven't seen the full effects of supply constraint yet. Lowest since September 21. Number was 490 in March, shutting down 15% of oil rigs 5-6 months. You still could have output going up with rigs going down, right? Let's see what we have next. First stock and option. And what age were you? Oh, early 30s. I forget. Honestly, I forget. What is your view on the debate of long-term decline in prices of commodities due to technological advancement versus commodity super cycles? Prebisch-Singer hypothesis. That's an old one. And when investing in the space, do you prefer a shorter time? I think you might be misquoting it here. What it said, and it makes a lot of sense. I guess I can see how I can fit technological advancement in there. It made a lot of sense, but it makes no sense today. So what it said was, it talked about the relative price. It didn't talk about the absolute price. It talked about the relative price between commodities versus manufactured goods, right? So that over time, the relative price of commodities versus manufactured goods would decrease. What that is saying is, if you take a car in 1950, 1970, 1990, 2010, 2020, and you priced it out in terms of, I don't know, pick any commodity, a pound of copper, so 1 pound of copper, that over time the car got cheaper. In other words, you needed fewer pounds of copper to buy a car. And let's just baseline a car as saying, well, let's just say it's a mid-size sedan, and whatever the mid-size sedan is, the average price of a mid-size sedan, that it got cheaper in terms of pounds of copper. So that if you had countries that primarily exported commodities but had to import all its manufactured goods, it would see its terms of trade deteriorate. Now, terms of trade is not a trade balance, right? So you can have a trade balance that is not good for you, but you can have good terms of trade. And it's the ratio of export prices to import prices. So let's say you take your export prices in your numerator, you take your import prices in your denominator. If you're looking at this ratio would deteriorate over time because the amount of commodities you're putting out, you'd have to put out the price of the vehicle is rising in terms of the commodity. I guess you could say it that way. Is the relative price between the two is changing. They'd see their terms of trade deteriorate. So what you would like to see is this ratio at 1, then 2, then 3, then 4. So let's say that you're running a trade deficit, but you have terms of trade, let's say the ratio is 3. That means what you're exporting, the export price index, is 3 times the import price index. Whatever number it happens to be, let's say it ends up being 3. So you're exporting high value stuff and importing low value stuff. So even if you have a trade deficit, you could still have positive terms of trade. Welcome to the US. That's exactly what it's doing. This was years ago when manufacturing was done in developed countries. And developing countries had no manufacturing capacity. They simply just exported goods. Well, today, manufacturing is done in developing countries. Not so much developed countries, but developing countries. We see it being in Mexico. You see it in China, right there, China. You see it in Vietnam. You see it in countries like that where low-cost labor. We go to countries with low-cost labor to do the manufacturing now. But we don't do it in the developed countries. So these countries typically exported the commodities are now doing the manufacturing at the same time. So it really doesn't mean anything anymore overall. Right? So I don't know that I would word it this way. But okay, can you elaborate on your position on AGI? Do you think it's very far out? It's non-existent. The general intelligence? No. General elegance? Sure. These things are not intelligent, and I think that is the word that screws everybody up. These things are, at best, cognitive domain emulators, CDE. And the cognitive domains that they can work on are not ones that are self-reflective. You're looking at recall, you're looking at understanding, you're looking at application. Once you get up to analysis, especially evaluation and creation or creativity, no. Because they don't have general intelligence. They are cognitive domain emulators, and they are elegant, but they are not intelligent. Their output, you look at the output, you say, this is really good. Yes, it's elegant output. It's not intelligent output. It was not produced by an intelligent system. It was produced by code that was written elegantly, and it does emulate certain cognitive domains because it takes this big probability space and it vectorizes all your language. And I do believe that, yeah, over time there are patterns in the language that if you're saying these things in this order, you probably mean this over here. And based on that, this is the highest probability stuff that exists there. And I'm going to see a whole bunch of high probability stuff that I would normally have to search for myself. That's the elegance of it. But it is not intelligent. So there is no AGI. None. Trade barriers were going to be imposed away. Do you think a quota would have been a better option? Well, I don't know so much that the quota would make a lot of sense. I don't know that the U.S. is in a position at this point in time to limit what comes into the country, because that would cause significant inflation by creating false shortages. So to say, look, there is no shortage of anything, it's just going to cost you more once, right? The price will rise, and then from there on, you'll pay that higher price, but there is no shortage. If you want to see inflation create false shortages, there's the pandemic. All the inflation we had was shortages, supply driven. So no, I don't like the idea of a quota system. The only way I like the idea of a quota system is if you have an industry, a domestic industry, which could supply the entire market. It could, but it cannot compete with the world price. Then a quota system would make sense to say, let's lower the amount that's coming into this country so that it does raise the price overall so that our domestic industries can produce. But what you don't want to do with your quota is create a false shortage, because you will absolutely create inflation that doesn't stop once. It's not a one-time hit. Government could have required exporters to purchase import licenses. When you say exporters, you mean the other country's exporters. Set the quota at or below the current import level, and then some things that come into the country, there is no domestic production on. You're going to set an import tariff on uranium? Well, then there's going to be some uncomfortable conversations in some communities that rely on power. You're going to set an import quota on potash coming into the country? Well, then some farmers are going to have to settle with lower yields per acre. Some things simply don't enter the country. Some things have no domestic production. All right? PPI 3.3. Yeah, PPI, and the last comment, PPI, there's no sugarcoating that. It was pretty bad. However, if we were looking for the footprint of a tariff, that is probably it right there. That the measurement period doesn't include the elevated tariffs. It includes the 10%. We probably have a situation where inventories were worked off and the new stuff coming in had the tariff. But that increases price once. It's not the same month over month. So what we've seen, what we could say is the data is consistent with the tariff. If you said there is a tariff, I would have expected to see something like this. It is consistent with the tariff. It is proof, I believe, that Americans are paying the tariff. If you want proof that Americans are paying the tariff, we had it today. They're paying the tariff, and that's the footprint of the tariff. Does it continue on next month? Next month, it could just be zero again, because it's an adjustment once, and then that's done. Now, next month, we might have the adjustments for these higher tariffs on certain countries right now, or the court could come out any day now and say, no, these are illegal, and it could all just go away. But I don't think this is inflation that we saw. I think this is the reflection of the tax that Americans are paying. Let's be clear, no matter who wants to lie to you about this, Americans pay the tariff. Americans pay the tariff, and this is evidence, I think strong evidence, that Americans pay the tariff. And that's it. That's it.